Okay, so welcome everybody to the Baker Institute Center for Energy Studies and our latest webinar. This one's titled Carbon Neutral Oil in Energy Transitions. It's an interesting and emerging topic in energy, this notion that we can drive down the emissions from oil and maybe even capture or offset some of those emissions. And eventually, we might even see some producers declare carbon neutrality. So the starting point for all this is really a wide variation in levels of carbon dioxide emissions from within the oil industry right now. And all oil emits roughly the same amount of carbon when it's combusted, somewhere around 75 grams of CO2 per megajoule. But that's really where the similarities end. And the emissions in the rest of the value chain vary really widely. So you got upstream emissions from getting oil out of the ground. It can range from anywhere from a low of about 5% to a high of almost 40% of the overall life cycle emissions from crude oil. So from about 3 or 4 grams of CO2 per megajoule to 30, 35, 40, or even, maybe even a high of even more than that, 50 grams of CO2 per megajoule, just from the upstream. So you add in the differing, transportation emissions and refining emissions, and you find there's pretty wide differentiation depending on where you get your crude, how far it travels, and who refines it. So broadly, the most carbon intensive stuff is from places that use energy intensive production. So Canada and Venezuela are two of those places, or from places that are flaring or venting methane. So countries like Algeria, Iran, Turkmenistan. But since oil is the world's dominant transportation fuel by far, and probably will be for some time, carbon intensity is not only becoming more important, but it's starting to become an arena for competition among countries and companies. So we might see policies like carbon taxes or border adjustment tariffs pushing exporters to really start to take a look at reducing or offsetting their emissions. And that's what we're going to talk about today. So we've got three fantastic panelists from all around the world here. So with us from London is Amy Bowe, who is the head of Wood Mackenzie's new carbon research team. This is her latest iteration at Wood Mackenzie. She's got a 17-year career in energy, previous work also at Hess and at Pira and at some other companies. With us from Dhahran, Saudi Arabia is Dr. Hassan El-Houjeiri, who heads Saudi Aramco's Climate and Sustainability Group. Hassan's life cycle carbon assessment modeling tool is one of those used by the state of California in developing its low carbon fuel standard. Hassan has also worked on Aramco's transport analysis team in its Detroit Research Center and also at Shell. He did his PhD at Oxford and his postdoc at Stanford. And joining us from Washington is Michael Cohen, BP's chief U.S. economist and head of oil analysis. Prior to BP, Michael was head of commodities research at Barclays Bank, where he wrote some fantastic research notes that I suspect many in our audience have probably read. He also did oil market analysis for the IEA and for a long time at the U.S. Department of Energy. So thank you very much, Amy, Hassan, and Michael, for taking the time to speak with us. So I want to start by giving each speaker 5 to 7 minutes, no more than 10, to outline a few thoughts on their research and how they see carbon competition evolving. And then after that, I'll ask a few questions and then we'll open up to audience questions. Please send me your questions through the chat function. So let's start with Hassan, then we'll move to Amy and then Michael. So Hassan, the floor is yours.
Thank you, Jim, very much for the introduction. I mean, I will follow on what you just mentioned to the audience on the variation in the carbon intensity in upstream operations and over the whole petroleum or transport fuel supply chain. And I will try to use my this few minutes to introduce the audience on the tremendous amount of research that has been done in this area in the last 9 to 10 years, I would say. So we started the journey early on in 2011, 2012, as you mentioned. The state of California At that time, they had strong interest to understand the variations in the carbon intensity of the crude oils that are refined in the state. So at that time, starting from a policy framework perspective or context, we worked on developing a methodological tool which is known as the Oil Production Greenhouse Gas Emissions Estimator, or in short, the OBGI model. So this model has formed the basis for a very long time now, almost 8 to 9 years, for regulators, policymakers, academicians, and of course the industry in understanding the carbon intensity from oil and gas upstream operations. Recently, of course, due to the developments in the methodologies and the tool development that has been championed by Stanford University, we embarked on generating a very high resolution data set using the OBGI model to understand the carbon intensity variation across the wide spectrum on a global scale. The study was published in Science in 2018, and it included or involved the bottom-up carbon intensity analysis of around 9,000 oil fields globally, which represented 98% of the global production for the reference year, which was 2015 for the study. This new data that was generated was the result of years and years of tool development and data mining exercises. And it enabled us to have a very, very close look at the whole spectrum across the globe, and to understand the scale of the emissions and the main drivers of the emissions intensity between different regions globally. And I would take, of course, I would pinpoint using those results that the results were confirmed the wide variations in the carbon intensities across the globe. On a field level, there is a tremendous, I would say, level of variation. On a country level, just to summarize, you can look at the very low or the lower bound countries versus high bound countries. Carbon intensity can be the upper bound can be 6-fold or 6 times as much as the low bound countries. So we see a very wide variation, and this results, as you mentioned, Jim, in a wide variation of something around 10 gram to 15 gram. So the 10 to 15% of the total wet wheel of transport fuels versus 40%. So it is very significant. Main drivers that we have identified, of course, were the flaring and methane leakage. This is no surprise to anyone. By reducing the carbon intensity of the emissions from these sources, particularly bringing down flaring to a level of around, let's say, 5 scuffs per barrel of oil produced, or bringing the methane leakage to levels that mimic the carbon intensity of methane emissions from the Norwegian operations, which is considered a best in class or in the industry. In 2015, we can achieve by only these two sources of emissions around 43% of emissions reductions. So gas management is a prime area of focus that was identified in this study. Additionally, of course, we know that the extraction of oil from heavy oil, from oil sands, is very energy intensive. And therefore, we kind of modeled or a scenario where the integration of renewable energy or using solar energy in the heavy oil and oil sands upstream operations can result in an additional 17% reductions in the global carbon intensity. But this is not the full story. You can see that the emissions from upstream operations are quite concentrated when it comes to what are the main drivers. additional emissions reductions and significant emissions reductions can be achieved by reservoir management, which can control what we call the water cut, or the amount of water you produce with every barrel of liquid you produce from the reservoir, which directly reflects the energy efficiency of the production process. So all in all, of course, we can take a point in case after I clearly outlined the main drivers. All in all, we can take the Saudi Aramco carbon intensity as a case in point, which confirms the results of the research. Saudi Aramco has a upstream carbon intensity of around 10.2 kilogram per barrel, compared to the collective level of 23 kilogram per barrel for the all OGCI members. And the reason behind this carbon intensity or low carbon intensity, the main reasons are two things: the low per barrel flaring rates, and also relatively low water cuts. As we said, the amount of water you produce for every barrel of liquid you produce is very important in reflecting on the efficiency. And that is a result of applying a set of technologies that and applying best-in-class reservoir management to be able to control the water cuts and to a minimal level. So this is, I would say, all in all, we can, the main insights from the upstream, we can dig more in our discussions on the whole supply chain. And I can, of course, take the time to address any questions, whether it's upstream or midstream or the whole supply chain. I'm very happy to provide more and more insights into these, into the carbon intensity on the supply chain.
Well,
thank you.
Thanks, Hassan. Yeah, we'll certainly have some questions for you. They're actually already popping in, so I've got a couple for you already. But let's move to Amy. Amy, 5 to 7 minutes. The floor is yours.
Great, thank you, Jim. So Hassan has talked about the research that Saudi Aramco has done into the emissions intensity of oil and gas assets and how that varies across the world. At WoodMac, we have developed a very similar model, actually also leveraging OpG, to look at the emissions intensity of the assets that we model within our upstream database, but then also be able to take that up to the corporate level to look at the differences in emissions intensity and performance across corporate portfolios. So as probably many of the attendees today know, the oil and gas industry is under significant pressure to both disclose the climate risk within their portfolios, as well as then to address that risk. And these pressures are coming from multiple different sources, some of which we might classify as sort of push factors, or what might be classified as sort of risk factors, and others which might be classified as sort of pull factors or opportunities around the energy transition. I'm going to highlight a couple of particularly the sort of push factors that have been, I think, probably most significant in really influencing the industry and the discussion and focus that this topic has received. So first, certainly there has been regulatory pressure as more and more countries are beginning to pass policies to meet Paris Agreement targets. And those policies could be direct regulatory measures in terms of requirements to, for instance, reduce flaring or improve methane leakage monitoring and repair. Or they could be indirect measures in terms of carbon pricing mechanisms, whether those are a carbon tax or a market-based sort of trading system. So that's certainly one pressure that is leading companies to really look at the emissions performance within their portfolios and address that. But one of the more significant pressures is actually coming from the private sector, and that's really the influence of investors. So in addition to the Paris Agreement, one of the other significant outcomes from COP21 in 2015 was the formation of the Task Force for Climate-Related Financial Disclosures, or the TCFD. And the TCFD was established in order to provide recommendations around the types of information that would be useful to investors and other decision makers in terms of determining how to basically align investments with a Paris compliant future. Now, the recommendations from the TCFD, and here it might just be helpful to share a couple slides, so I'll pull that up as I speak. The TCFD recommendations span 4 different categories in terms of the types of information that are seen to be decision useful. And that includes, I can get these up on the screen, governance, strategy, risk management, and metrics and targets. I'll try to put this presentation mode. Now, these guidelines apply or are meant to apply to all companies, regardless of sector. However, there are supplemental guidelines for sectors that are perceived to be heavily exposed sectors. And those supplemental guidelines require more,
sorry, Amy, Hassan, can you mute your mic? I can hear some background noise there, please.
And can I just confirm that you all can see my screen? I seem to have had a blip on the computer for a moment.
Yep, we can see it.
Okay, hopefully it'll be back in presentation mode. But the supplemental guidelines effectively require greater disclosure within each of these categories. So in particular, for instance, strategy, one of the requirements for all companies is to conduct scenario analysis in terms of understanding what the climate risks are under a range of climate scenarios, but in particular a 2-degree scenario. And in terms of metrics and targets, which is probably most important for today's discussion, that includes recommendations to provide a breakdown of emissions by scope 1, 2, and 3, as well as provide both historical information in terms of trends, as well as forward-looking projections broken down by geography, business line, or asset type. Now, these guidelines apply not only to the energy sector, or oil and gas is one of the heavily exposed sectors, but also to the finance sector. And because banks in particular are coming under a lot of pressure to understand the climate risks within their own portfolios, they in turn are putting additional pressure on oil and gas companies to provide transparency around the emissions associated with their portfolios and assets. Now, in addition to transparency, which again, the TCFD guidelines will hopefully address, one of the other sort of primary challenges has been standardization. So even those companies who do disclose data around their emissions performance, they tend to use very different first frameworks and methodologies for calculating emissions. They also differ in terms of the bases of disclosure, with some companies reporting data on a gross operated basis, some reporting on a net equity basis. All of that data tends to be relatively high level at a corporate level, or perhaps at a business unit level, despite this call for sort of greater transparency at the asset level. I don't know of any company that provides that level of granularity quite yet. And even things like the greenhouse gas emissions that are included within the data that companies report can differ. So all of these differences make it quite difficult to be able to assess how companies are performing relative to one another, as well as relative to where they need to be performing in order to meet Paris Agreement targets. So that was sort of one of the primary reasons that Wood Mackenzie developed our emissions benchmarking tool. And here I've just put together a slide that summarizes the average emissions intensity for 2020 based on our data for a few select companies based on peer groups, and then also shows how that relates to the underlying composition of the portfolio, because as Hassan mentioned, there is a wide range of intensities associated with different oil and gas assets, even within resource themes, but certainly there are some trends that come out in terms of resource themes, and therefore, the composition of a company's portfolio based on those resource themes can have a big impact in terms of its overall emissions intensity. Now, we also look at emissions intensity associated with refining operations and downstream. So that's reflected here as well. So in these bars, that shows the percentage of the portfolio by upstream resource theme, as well as including the contribution from downstream operations. And then the diamonds reflect the average emissions intensity of these companies' portfolios, at least in terms of their scope 1 and scope 2 emissions, so direct emissions associated with operations and indirect emissions associated with purchased electricity, heat, or steam. On the sort of right-hand axis, and we've measured that in kilograms of CO2 equivalent per BOE. So we include both CO2 emissions as well as methane emissions, hence the CO2 equivalent. Now, you can see, even at a corporate level, there is quite a bit of variability in terms of emissions intensity. And again, a lot of that does relate to the underlying composition of these portfolios. So you can see, for instance, if we look at the majors in particular, Equinor has the lowest emissions intensity. Some of that does relate to the fact that their portfolio is heavily concentrated in sort of conventional offshore and deep water assets, and they have a very small contribution of refining. But also this does reflect the fact that Norway has some of the most stringent carbon regulations globally, and there's a lot of focus on reducing emissions intensity, which has also helped to keep that down. By contrast, if we look at some of their other major peers, which have more diverse portfolios, particularly large contributions from, for instance, LNG, which is in yellow, or oil sands, which is the brighter green, such as Shell, for instance, then you can see that there is a much higher intensity associated with those. And the same follows for other peer groups as well. So within the NOCs, as we can see, Saudi Aramco and ADNOC as well have some of the lowest emissions intensity, which does reflect the very long life nature of those assets, the strong drive mechanisms. And that's in contrast to, a company like even Qatar Petroleum, also located in the Middle East, which has a very large contribution from LNG. So on average, in terms of these peer groups, the majors actually have the highest emissions intensity across the peer group, and the NOCs one of the lowest. But again, you can see there's a wide range of intensities in between. So how are companies responding then to these pressures? Wood Mackenzie has characterized, I guess, 3 broad energy transition strategies that companies are taking, which are summarized here. So the first is diversification, and that refers to transitioning, I guess, away from oil and gas as the core sort of revenue driver for the business, and into lower carbon value chains, such as power, and in particular within that renewable power, also more customer orientated solutions. And this is really being dominated by, in particular, the European majors, though it's not necessarily exclusive. The second strategy is to more focus on decarbonization. So really bringing down the emissions intensity of oil and gas portfolios, as well as building out perhaps carbon management businesses, particularly CCUS. And here we do see, for instance, some of the US majors focusing more. ExxonMobil obviously just announced a huge CCUS project in the Gulf. And then the third is really around market capture, which is using an advantageous positioning from a cost perspective, as well as a carbon perspective in some cases, to really capture market share. particularly as other companies diversify away from oil and gas and focus on other sectors. Now, these aren't mutually exclusive. For most companies, the strategy might involve aspects of each, but it's really more a focus of, I guess, a difference of focus in how companies are focusing.
All right. Well, thanks very much, Amy. Really interesting stuff. We're already getting some requests for your slides. Any chance that you might share those?
Of course, yeah, happy to do that.
That would be awesome. Yeah, those some really good data on those. Okay, let's turn to Michael. And Michael, the floor is yours. And then we'll break out and do questions after that.
Great. Thanks, Jim. It's an honor to be here with all of you. You had asked me to share a bit of a BP-centric view on how we are navigating this space, and I would characterize the three general business areas that we are engaged in and we are focused on. One is resilient and focused hydrocarbons. The second is low carbon electricity and energy, and then finally convenience and mobility. And on the first issues, I want to highlight a couple different examples right here in the Gulf of Mexico, right there in the Gulf of Mexico, where a lot of you are close to, that we've done on our operations there. And the first is that we've upgraded offshore drilling units so that they can run at higher efficiency. We've replaced some of the turbine bundle at Thunder Horse, and that's allowed us to reduce power demand. At Atlantis, we've installed controllers that have helped reduce offline trips, which also helps to reduce flaring. And then we've also made improvements to how we service the platforms and reduced fuel consumption in the helicopters and other servicing vessels. And the other way, just to think about how do you define resilient and focused hydrocarbons. You know, this isn't just focused on the upstream. At the Lingen refinery in Europe, we're planning to jointly develop a 50 megawatt electrolyzer project for green hydrogen production. That's a project we're working on with Ørsted, and that offshore wind project will initially replace 20% of the natural gas-based hydrogen that's used at that refinery. So that's what we're talking about, at least a small subset of the things that we're talking about when we think about resilient and focused hydrocarbons. And then in that second area, low carbon electricity and energy, there's a whole host of different activities. I'm not going to go through every single one. A big scale up in our existing renewables business. We want to make it some of the best in the world. We're growing our solar position through Lightsource BP, which is already in Europe the largest solar developer, and now we're taking it from 5 countries about 2.5 years ago to over 14 countries in the coming years. We've got a 3.7 gigawatt pipeline of offshore wind projects in the US and the UK. And then a big hydrogen project that we're working on at Teesside that goes to service 20% of the UK's hydrogen target by 2030. And so then the final area that we're focused on is that in the mobility space. Last month we announced a partnership with Volkswagen to expand EV charging across Europe. We're doubling charging points just in the UK. We've got a partnership with Didi in China that already has about 500,000 EVs running on it. In Houston, I want to highlight we have a partnership with the city that we announced, and we're expanding EV charging and planning through a partnership with the city. And so all of this is along the way of helping us to transform from an integrated oil company to an integrated energy company. And I think it's important to understand that when we talk about decarbonizing the upstream production, we saw one company highlight an example of a completely carbon neutral cargo. We've seen other companies talk about doing the same. But I think the scale of the problem cannot be addressed just by offsets alone. And I think that's an important point to make as part of this discussion. And what we're seeing right now is sort of interim solutions to the decarbonization problem and to the climate problem, and that's why we have made the shift that we have. We of course understand and realize, and this is shown in our macro analysis, that the world will continue to use oil and gas for many years to come. But there is a plateau, and I think it's important to understand that if we do want to get onto that lower carbon pathway to avoid the risk of climate change, then something more than just offsets has to be done in order to do that. So I look forward to our discussion. There's a lot more I could say about BP's strategy, but I look forward to other questions in the discussion. Thanks.
All right, thanks, Michael. Great stuff. Yeah, you've answered one of my questions already about offsets. So that's good. That offsets themselves aren't going to be enough. I mean, we're talking about a lot of emissions from oil companies, especially when you count in the Scope 3 emissions, the emissions that your customers, are emitting. By some measurements, Saudi Aramco is, about 4 to 5% of global emissions right there. So once you start talking about offsetting all these emissions, it looks pretty difficult. So I've got a bunch of questions from the audience. I've got I've got a couple talking about measurement and certification and how some of the methodology for measuring emissions. I've got one on the carbon intensity of fracking, and then I have some on LNG and shale gas on how they are why they are seem to be more carbon intense. What are some of the things that make them carbon intense? And so like to jump to a couple of these. Maybe Hassan, could you talk about first about the way the emissions are measured and about this issue of certification? I know Amy talked about transparency, but and there's a lack of transparency. There's different measurements, but different techniques. But maybe you could talk about this, at least the methodology that you use to measure emissions. Maybe Amy might chime in on that to talk about how WoodMac does that, and then eventually the certification process, how that might work.
Yeah, thanks. I mean, this is a very good question. I mean, the answer is not as easy as the question, to be honest. Amy, I think she captured one very important thing, which is the discrepancies among the oil companies in reporting emissions. So the use of different system boundaries or the use of different denominators in the methodology that is adopted by different companies in reporting their emissions has been already identified as an area of collaboration among the different oil companies. And I think this is something that also IHS, Wood Mackenzie, and all the think tanks are also deeply involved in trying to help the industry in resolving. So this is an area of collaboration. I think this is also something that we bring on the table in the Oil and Gas Climate Initiative, which is a collaborative initiative among the major oil and gas producers globally. However, when it comes to certification and verification, there are clear processes, about the IPCA. The IPCA also have set a lot of standards and guidance to help the companies in following certain protocols and certain guidelines to report the emissions. So I would say that the reason behind the discrepancies would be that the guidelines are still, allow a wide range of options. It's not restrictive. So we need to resolve this by having a more unified methodology. However, the verification is pretty straightforward. All reported emissions by the oil and gas companies is third-party verified by kind of specialist third party are adopted and recognized third party verifiers on global scale, that's when it comes to GHG accounting. Also, I would like to draw here that the research that I have been presenting or presented at the beginning of the panel discussion is basically what we call modeled emissions, and I think what Amy presented to lies within this category. These are estimated emissions that are used using what we call oil and gas carbon intensity estimators. So there is a level of uncertainty, or a good level of uncertainty in the measure, whereas reported emissions are based on GHG accounting. They are verified and they are more specific to the individual company's performance on carbon intensity.
Hassan, who are the companies, these third-party companies that are auditing emissions?
Well, I cannot name them straightforward, because this will give the implication that I'm disclosing who is the third party that is verifying our emissions. But they are very well known and recognized in the industry as part of their services. Right
on. Okay. Did anybody want to add anything on this, or?
I might add something. So maybe a couple points. First, around I guess addressing this point of the margin of error. So as Hassan said, both the work that he has been doing as well as with McKinsey's own models are definitely estimated approaches. And so there will be a greater sort of margin of uncertainty associated with those. But what I think is important to also mention is that even within, for instance, the GH2 protocol and the IPCO guidelines, the API compendium are kind of based on the GH2 protocol. There's also, as Hassan also mentioned, sort of a range of accepted methodologies for calculating emissions. So, they kind of fall along a spectrum. On one end of the spectrum, you have a methodology that effectively sort of counts up types of equipment. And, for every type of equipment, there's some standardized sort of emissions factors that are associated with it. And so, that's one measure that can be used for calculating emissions. At the other end of the spectrum, you would have directly measured emissions, which is, probably the most accurate, because it's actually, looking at what, a field is essentially emitting, or facilities are essentially emitting. And in between, there's, probably more of a sort of mass balance type exercise where you're looking at the types of equipment, the fuel efficiency, the fuel balances associated with those, etc. So even within the frameworks that companies are using to report, there is a range of allowed methods that have a range of uncertainties associated with those. And to some extent, it's that recognizes that companies are in different positions with relation to the assets in their portfolios in terms of the knowledge, I guess, about the information that they have to even compute these. But certainly, what makes it even more complex then is that not every company is even using a standardized framework. And some of that is driven by regulation, and that's probably another important point to mention. That, for instance, in countries like the US, where companies do have to disclose emissions to the EPA, most companies are using the EPA reporting requirements, which are very different from the GH2 protocol. And some companies that are US lower 48 focused players will report emissions in their corporate disclosures under EPA guidelines, which therefore makes those incomparable with companies like BP, for instance, who are using GH2 protocol. So there does need to be a greater standardization in terms of at least the frameworks that companies use, and to the extent that emissions disclosures are perhaps mandated eventually by regulatory authorities such as the SEC, if in the Biden administration has suggested they might go down that route. For instance, it's starting to be required within the UK for UK listed companies. That will help with this standardization issue.
Okay. All right. Well, another big question, especially the one that I have, is how do companies monetize their investments? And we're seeing some pretty big numbers talked about in decarbonizing their upstream, and actually Exxon's big announcement of investments to create a carbon capture and storage hub here in Southeast Texas, storing the carbon offshore. There's some pretty big numbers here. How do companies monetize this? I mean, right now it's in most countries it's free and legal to emit as much as you want. So are there pathways to actually making money from these, or getting a leg up on the competition from having lower carbon oil? Why don't we start with Michael, and then Amy, if you want to jump in, and Hassan.
Sure, I'll start on this just from a BP perspective. I mean, I think it goes back to rethinking what our financial frame is, and that financial frame is one that continues to provide a strong dividend, strong credit, paying down our net debt. We continue to invest at scale and have the ability to invest at scale in the energy transition, but we're also, as we say, performing while we are transforming. And the cash that we are allocating to these lower carbon investments still has to meet a wide range of sector-specific rates of return. Those hurdles range between 10 to 15%, and we're doing that via partnerships. And of course, we have to think about, in general, why are we doing this versus investing in other areas? Why is that diversification make sense, and what is the shareholder proposition of that diversification? It's clear that going forward, electricity may not experience the same kind of volatility in terms of prices as oil and gas might. It's clear as well that oil and other hydrocarbon intensive production may face higher cost of capital going forward that is likely to raise break even. So that also justifies some diversification. And I think that, again, taking a big step back here, and others can chime in on different aspects of answering this question, but our shift in strategy is meant to ensure that we are, as a company, resilient to multiple scenarios, as TCFD and as Amy highlighted. So the strategy that we are shifting into is one that can be profitable, and that we know is profitable under those different scenarios going forward. So I would just highlight and submit those broader picture questions to how we are hoping to monetize some of these new diverse energy areas for us.
Well, okay, that's interesting. Amy, how about just the upstream carbon or carbon reduction specifically? Are there ways companies can monetize that specifically to compete on, if there were a carbon tax or carbon border tariffs, would those reductions, would they eventually become more able to market their oil than a higher carbon country or company?
Yeah, certainly. I mean, I think it's early days still, but we are starting to see initial indications of emissions intensity being sort of a competitive factor within the market for commodities. So the fact that we have seen, for instance, companies announce carbon neutral LNG cargoes, more recently carbon neutral crude cargoes, that's sort of a precursor to where we would sort of see maybe the market moving more generally. And we have seen, in addition to this sort of desire to deliver carbon neutral cargoes, emissions intensity has also been a criterion in some LNG contracts, for instance. So if you take some of the drivers there in terms of, buyers being concerned about the emissions intensity of the fuel that they're procuring, as well as some of the market changes that might come about, for instance, through the implementation of a carbon border adjustment mechanism in Europe, and that would sort of qualify, I suppose, as a regional scale sort of concern about emissions intensity associated with purchased products. We can imagine a future where there does, I guess, one of two things. One, emissions intensity either becomes a competitive factor in the market, and you can be sort of in order to compete in that market, you're going to have to meet certain emissions intensity criterion. So it'll sort of be you either meet this or you don't, and those who don't can no longer sell into the market. But you could also imagine a scenario where instead products become differentiated on the basis of their emissions intensity, and perhaps there are premiums associated with those that are seen as less emissions intensive, more environmentally friendly on other metrics potentially as well. And so that would be also a sort of positive way to then profit by reducing the emissions intensity associated with operations and with gas or oil supplied. One other one I might mention, which is sort of relevant to this, is around carbon management. So obviously a lot of companies are turning to CCS as a carbon management tool. Sometimes that applies to their own operations, but the industry is also looking at how they can use CCS to help other industries decarbonize, and in this way perhaps also deal with some of the scope 3 emissions associated with use of products. And in that scenario, especially where companies are actually managing other industries' carbon, there's going to have to be a business model around that. It's not just the pricing of carbon. You can imagine a business model where there's effectively tariffs and fees associated with transporting, storing, managing that, and that would also be a profitable business model.
So it sounds like some of this is jockeying for position based on where policymakers are or where companies think policy is going, and then once you're you've got that low carbon oil or lower carbon oil, you can compete on that, and then these regulations will kind of they'll start to push a virtuous type of competition where we're seeing there's already differentiation among crude types, as I mentioned, between say Saudi and Venezuelan crude, where if you had a $50 a ton carbon tax, you might have a pretty substantial discount for that for the Saudi crude if the tax differentiated among crudes by upstream emissions. But then you hear about plans by some of the IOCs and Occidental here in Houston talking about offsetting or by sequestering carbon to 50% of their emissions, and eventually 100%, including scope 3 emissions. That would lower their the price of their oil substantially. It would take away all the entire carbon tax if they were sequestering as much as they were as their oil would emitting. That oil would not be taxed and it would be much cheaper, right? So Hassan, did you want to weigh in on this? I know, Saudi Aramco has been touting its lower carbon intensity for some time now. Is there anything you can say about Saudi Aramco's strategy?
Well, I mean, I wanted to add something that's very important. I think that the prerequisite of recognizing the variability and the heterogeneity of the carbon intensity performance of oil and gas supply chains starts with basically avoiding a big mistake, which is sometimes downplaying the magnitude or the size of the emissions reductions and their impact on the future climate goals and climate scenarios. This is a very important thing to pause on. We actually looked through our research into understanding the magnitude of emissions reductions if applied across the oil supply chain on a global scale by applying upstream technologies like, as I said, focusing mainly on reducing flaring, not to zero. We reduce the flaring all the way down to 20 scuffs per barrel in our scenario analysis, whereas the global average today is 180 scuffs per barrel. I would say Saudi Aramco's average, more or less, is, we flare less than 1% of our raw gas that we produce, which is around 5 scuffs per barrel. So you can see the variation here. So even at the 20 scuffs per barrel, by minimizing extremely the methane leakage and applying in the refineries carbon capture and storage technology, in addition to low carbon utilities such as steam and electricity. So we did not even tackle every single source of emissions, but we focused on the major ones across the supply chain. And the results came out to be that the savings by the end of the century, only by applying those across the supply chain, can go all the way up to around 79 gigatons, which is roughly speaking around 1 gigaton a year of emissions, which is around 120% of Germany's emissions, or 80% of Japan's total emissions every year. So we are not talking about small amount of emissions. And I think that one of the issues that we are facing in the climate debate is underplaying the importance of tackling those emissions, given that I think everyone agrees that oil will remain to play a major role in the energy mix by 2050. So first of all, I think we need to recognize it, recognize the importance, which would drive policies and would drive mechanisms that would recognize and basically remunerate or provide a premium to low carbon intensity performers at the refinery gate or at the market. So the way we see it, or I personally view it, when you go and buy, if you're talking about the market, when you go and buy a gallon of gas, you basically have RON and MON as the criteria to buy a specification of the fuel that you buy. I think that one day carbon intensity should become one of those criteria. The same when we talk about crude oil trading or crude oil purchase at the refinery gate. Today we have references such as WTI and Brent that are characterized by specific, some API, sulfur content and other properties. And we see that a future where at the refinery gate, the carbon intensity should be factored into the valuation of crude oil to promote and to drive the technology investments and the decarbonization investments that are needed to tackle this significant range of emissions reductions that we are talking about.
All right.
And Jim, can I just add, in this question of how to quantify what this might mean over a long-term basis, to try to value what would it mean if we, for example, took the carbon tax that is applied in various scenarios, what that would mean for crude. I wanted to just share very quickly this scenario analysis that we did, basically comparing a rapidly decarbonizing scenario where carbon tax increases to upwards of $200 per ton versus a BAU type scenario, and then taking the research that Dr. El-Houjeiri along with his colleagues have done on carbon intensity, what that would mean to the dispersion of crudes that might be available by 2050. And it's clear that that highest carbon intensity quartile of crudes would see a reduction of about 1.5 million barrels a day. In addition, that middle two quartiles of carbon intensity also declines versus a BAU scenario where carbon prices or the carbon tax doesn't really change at all. So it's clear that this will have an impact in the slate of crudes available if the carbon tax were applied.
Well, Michael, if you can leave that slide up for a second,
Sure.
that leads me into one of our audience questions here about carbon intensity of fracking in U.S. production. The U.S. is up at the upper half of emissions intensity there with a pretty broad range. What do you think? Others chime in too. What do you think would happen if the U.S. started imposing a more stringent regs on carbon, maybe a tax? could the U.S. move down the chain and sort of compete with some of the producers on the lower end, or is fracking just too energy intensive?
So sorry, I lost you there for a second, but I think just generally, clearly the more that the industry does to sort of limit the environmental footprint, the longer that it's going to play a part in.
Oh, I think we might have lost Michael there.
Sorry, can you hear me now?
Oh, there we are. Okay.
Sorry about that. I don't know what happened. Anyway, no, I think that it's important that there's going to be a continued focus on reducing fugitive emissions, methane emissions of all, and carbon emissions of all types, down in when we think about shale basins. And I think that as we focus, on what a carbon price might do, it's clear that if companies start to look at the environmental footprint of their oil and gas production, it's going to also increase transparency, accountability in terms of reducing methane emissions. So yeah, I think the work that WoodMac has done in evaluating the CI of shale production and tight oil production and gas production shows that it's basically on the lower quartile in terms of emissions. But I think the question is, how will those producers deal with a world where they're being held to account for scope 3 emissions? Because then it's not just about continuing to improve the CI of the production process, but also what's used at the other end.
Amy, did you want to weigh in on this?
Sure. So I think our research suggests it's not fracking per se, which makes assets perhaps more emissions intensive. And according to our data, it's sort of middle of the road on average for shale and for tight oil and gas. A lot of what is contributing to the intensity from those sources is, though, more around gas management. So in particular, flaring as well as methane loss management. And some of that relates to, I think there was another audience question asking about, are there positive returns associated with stopping flaring? And that answer is really dependent on the market that you're in. So one of the biggest problems, for instance, in the Permian has been sort of the low, natural gas prices that have prevailed over the last few years. And it simply hasn't necessarily been economic to invest in the infrastructure to monetize more of that gas relative to the returns that you would get for that gas in the market. Would that shift if there was a carbon price, though? Potentially. I suppose it depends on the level of the carbon price and how that gets applied. But that is, I think, more the issue than fracking itself.
Right, gas management. Okay, well, look, I have a bunch more questions I'd love to ask you guys, but we're kind of running out of time here. It's been fantastic having you all. I'd love to keep things going and do this again sometime. But I think this is a really interesting emerging area that we've sort of scratched into today, and there's lots more to do on this. So I really look forward to seeing more of your research, Amy and Hassan and Michael, and look forward to talking to you soon. On behalf of all of our participants, wanted to extend you guys a really heartfelt thank you, and hope to see you again soon. For all our audience members, thanks so much for coming, and please stop back when you get the chance.